Hi, it's Larry McDonald with the Bear Traps Report. Thanks for joining us. Quick update. We've got Valentina Sanchez in Latin America. Robert's up in New York. The team this morning, we run behind us a Bloomberg chat with institutions in 23 countries, hedge funds, mutual funds, pension funds. On Monday, we made an observation, kind of giving you a lens on that buy-side conversation around what clients were saying in the chat. And Robert made the point, and I made the point on Monday, that credit in the banking sector was deteriorating while the NASDAQ, the semiconductors were making highs. Oftentimes, credit leads equities, especially on the bank side. And so the bank credit deterioration all week was kind of a precursor warning sign for the equity market. And what we do is we measure the rate of change. You can see that Bank of America in the red there. We measure Robert has a model in our Bear Traps model. We measure the rate of change and deterioration in the credit. So if the credit is deteriorating at 5 miles an hour, not a big deal. But if the credit is deteriorating at 90 miles an hour, that is going to spill over to equities. And so we made this call on Monday around equity volatility. The VIX was trading extremely cheap relative to the deterioration in bank credit. As you can see here, the credit default swaps on Bank of America and Citi are deteriorating at a very, very fast pace. Next slide. Next, we're going to look at PCE, I believe. So the Fed has this dilemma. Here's what literally is the most important driving factor in the market, right? The Fed is trying to kill inflation, but at the same time, they're literally knocking the banks into a really, really, really bad spot. So if you're the Federal Reserve of the United States and think about equities, how we're going to deal with this, the Fed is basically trying to kill inflation, but we've got labor strikes all over the country. So, and we've got oil prices that are really being controlled by the Saudis. So we have all these things keeping inflation relatively high. At the same time, the Fed is trying to has that 2% target on PCE. We're light years away from that. So in other words, the Fed has a dilemma. If you want to reach your 2% target, at this point, there's so much stress in the banking system. I mean, think about Bank of America, right? When Lehman went down, one of the points I made on Twitter this week, when Lehman went down, its core capital was treasuries and short-term high-quality instruments, right? Their poor quality assets were mortgage-backed securities, commercial real estate, CMBS, our CDOs, and all those other things. So what happened in the last crisis was we had a deterioration in credit quality on the bad tertiary assets. Now, here we are, here in 2023, 15 years after Lehman, and the bank core capital, treasuries and mortgage-backed securities today are being really pushed down in value by the Fed, through this rate hiking cycle. Interest rates up. All the bonds that are on these bank balance sheets are in real pain. So the bank's core capital, the Bank of America, is under enormous stress. And so what does the Fed do? Do they impair Bank of America? Bank of America's leverage has gone from like 20 times to 30 times. We think now 44 times. But if interest rates go up a little bit more, leverage at the banks might go up to 80 times leverage with a 6.5% treasury. So this creates a real dilemma for the Fed. Robert, I want to bring you in here quick and talk about, I think you were looking at Yellen last night and what she's up against with the move up in bond yields.
Okay, so there were two things that were playing a role in yesterday's sell-off. In the morning, you had the JOLTS data that came in much stronger than expected, and in the afternoon, it became clear that Speaker McCarthy in the House was going to be ousted. Is going to lose support. And of course, that opens a whole can of worms about are we going to get a shutdown in November when the continuing resolution, the funding, the temporary funding expires? And will the United States incur another credit downgrade? So in the afternoon, also, Janet Yellen came out and she was having a speech at a private sector event. And she was giving a bunch of interesting comments. One was that it would get the fiscal under control, but the other one was she was saying that the Fed's suggestion about higher for longer She was suggesting it was by no means a given. Those were exact words,
So, but Rob,
and it
the
could.
point is, I mean, we got to make this very brief. So the point is, the interest rates are stressing the banks violently,
So it's
and
clear
now
that the
the U.S.
government is.
Treasury is getting nervous.
Yeah, the government is getting nervous. Janet Yellen has a secret card up her sleeve. She can roll out another bond purchase program. The Fed can stop quantitative tightening if they're really getting concerned about the bond long end, which is really what we're talking about, spinning out of control. It's putting pressure on the banks. It's putting pressure on real estate investment trust. We've seen them underperforming now. It's obviously putting a pressure on utilities as well. It's obviously financial conditions right now are back on the rise. That means for the average consumer, it's becoming more expensive, to borrow. We just saw this morning the credit card data from Citibank coming in with a decline of about 10% year over year in spending. And then lo and behold, this morning we also saw the ADP jobs report coming in, and it came in very weak.
Yeah, yeah. So, Rob, your
Completely.
point is, and we're hearing this from clients in the chat. So, institutional investors that Robert's been talking to say that the deterioration in the U.S. economic data is much more significant than meets the eye. That's
Yes.
the
And there are also now is more attention being thrown at how the government official data is actually being revised after the fact, and it turns out that to be much weaker. This we saw with the GDP numbers, with consumer spending. We saw that with the JOLTS data, actually. So, the economic narrative is one from, oh, the economy is still very resilient. We have a strong consumer. Yes, the consumer is very strong, but that's just 10% of the consumer, right? The 90% is really struggling here. And now we're dealing with bond yields that are around 4.7% on the 10-year. How do we see this, right? In the face of a very weakening economy. So eventually, and this is basically what this discussion is really all about, eventually we could see monetary and fiscal, right? Janet Yellen and Jerome Powell starting to take measures to take control over the long end, right? Because
Yeah. So,
clearly the
so hold on.
economy is starting to
Robert,
falter.
we got to keep it. Okay. So what you're talking about is the beast in the market essentially breaking the Fed. Like I said, they're nowhere near. They're nowhere near the PCE 2% target. Their core PCE target. They're light years away. So what you're saying is the beast in the market, stress on the long end, plus deteriorating economic data is going to force the Fed potentially into really ending their potential forward guidance around the November rate hike. I think with like you said, with the government shutdown, the Fed meeting's on the 1st of November, and now with this new speaker, we're going to potentially shut down on the 17th of November. I mean, how can't hike rates? That's what you're saying.
Powell cannot hike rates when there's a looming shutdown. So we basically with a temporary speaker, but we're out without leadership in the House. The House is in control of the purse. They decide what the spending is going to be. If November the 1st, the Federal Open Market Committee has decided on interest rates, they cannot possibly hike rates when there's a risk of a shutdown. And lo and behold, odds of a rate hike were 33% yesterday. They're down to 20% today for November. But I think, to your point, if there's too much banking stress, the Fed, the FDIC, which basically is Janet Yellen, can do a number of things. They did that in March. If that's not enough, then they have to start controlling the yield curve. And if that goes against their ostensible mandate of price control, then so be it. So that
So
creates
that, but
it.
hold on. No, that line is the key. If they get forced into really containing, I feel like I'm pulling out the fire hose on the bank risk. And as you can see here, triple C's now are wider than February. So the Nasdaq and the S&P are up since February. I think a bottle. Well, I think the Nasdaq still is. But you've got credit risk, high yields almost 100 bips tighter on triple C's since September 4th, as you can see there on the right side of the screen. So credit at this pace in like 4 or 5 days is going to be, we're going to be back on triple C's above 10% at this pace. As you can see, once again, our models track the rate of change in credit. And as you can see there, the rate of change in triple C's, that rate of change has been very violent, almost as violent as it was in March. And so now credit risk, interest rate risk on the Treasury side is hitting the banks, and then now that's hitting triple C's. Next slide. Who was it? I'm sorry, Rob. Your point.
Yeah, I mean that's what's happening here. An interesting tidbit is that when you're talking about the FANGs, they have about $550 billion of cash and equivalents on the balance sheet. So if they can deploy it at 5%, they're making $28 billion a year on that cash. So that's almost 10% of the net income. So people are wondering why the FANGs are so resilient. Well, they are actually benefiting from Fed policy. Well, an increasing amount of corporates and consumers are struggling under it. So one thing that have been, catching our eye is the revisions, right? So when you look at the JOLTS revisions, right, the blue line is the increase month over month. So JOLTS jobs openings increased by something like 600,000 jobs month over month. So from July to August, right? This is very these are
So,
kind of
Rob, we're
stale
going to
data.
make this really clear. So that's job openings. That sounds like a solid economy, right?
Yes. So one reason why we care so much about this is because the Fed cares about these numbers. And the Fed cares about these numbers because job openings suggest a strong labor economy, a strong jobs market. A lot of employers are looking for to hire people, for employees. They need employees to fill open positions. And what the Fed is really worried about is if there's not enough people to fill these open positions, because if there's not enough people, then the companies have to raise wages in order to lure employees away from other companies. And then you get a wage price spiral. So they're terrified. That's why this number is so important. That's why the market was jolted yesterday morning when these numbers came surprisingly strong. But what they overlooked, and I don't know why they did, was is that the revision for July was a million job openings losses. So the revision was a million less than initially reported. So, and that's what we see month after month. We see massive
Yeah,
downward
Valentine made this
revisions.
point last week. Like the revisions are just over and over again. Like the headline that comes out is rosy the last 5 months, 3, 4, 5 months. But then the revisions, Valentine, you made that point that they just keep coming in. So the headline versus the revisions over and over and over again. There's a distortion going on.
Yeah, we saw that last week with the consumer spending component in GDP. The final revision was a meager increase of 0.8%, whereas the initial report showed, I think, a 1.3, 1.4% increase in consumer spending quarter over quarter. We started with the non-farm payrolls. They did massive revisions in prior months, that's lobbed like hundreds of thousands of jobs out of off of non-farm payrolls. We've seen it time and time again. We see the revisions. And what we see in the general market day in and day out is every central bank in the world has now made the dovish pivot. Lagarde, the president of the European Central Bank, this morning said we are not going to raise rates anymore. The Bank of New Zealand overnight said no more rate increases. It's fine. Now we have a tightening cycle well on its way that does what it has to do. We just saw the Bank of Poland this morning cutting rates. We saw the Bank of Brazil has been cutting rates. We saw the Bank
So
of
Rob,
Chile has
let's
been cutting
get
rates.
let's get to the point for market. So
The only
the
standout
divergence.
is the
Rob, let's get to the
Fed.
point for market. So the divergence between, let's keep this really simple, right? The
Well,
divergence between the U.S. and the rest of the world is so wide, and that's pushing up the dollar. That's creating more systemic risk.
yes, so it's putting yields higher and higher every single day. That's putting pressure on the dollar, and putting pressure on the dollar is putting pressure on corporate profitability. Putting pressure on yields is essentially taking people's spending power away because they have to pay more to borrow money, whether it's a mortgage. So and our surprise is that the data show when the revisions come in that the consumer is not nearly as strong. So the Fed doesn't really have to be this hawkish. So the question ultimately
Rob,
is
Rob, in English, please, in English.
What?
English, Rob. Like, keep it simple.
English.
Okay, so at the end of the day, the Fed is pushing against all the other central banks. That's putting the dollar higher. That's creating a credit risk. That's putting pressure on profits, and it's putting stress in the market. And that's the dichotomy that we're faced with right now. So the question is what's going to break? What's going to break first? Does the Fed throw in the towel, or do we have to see a bigger drawdown in the markets that pushes the Fed into backing away from further rate hikes?
And you're speaking here, like right into the next slide. So, interest rate risk, the move index is your measurement of volatility on bonds, right? Whereas the VIX is your measurement of volatility on equities, and then you've got the currency vol there as well. What's interesting is over the last year, for many times, interest rate risk and bond volatility has led equity vol. Not every time, but a lot of the times. So as you can see here, equity vol is still very cheap. So the VIX, anytime you get the VIX that's sub 19, sub 8, and we made this point on Monday, the equity volatility is very cheap to interest rate risk and bank credit risk. And as you can see here, the move index is pretty violent move relative to the VIX there. Next slide. We're going to go into the dollar. Okay, so new lows on the NYSE, 254 yesterday versus 208 during the regional bank crisis. So as you can see, in terms of Powell up against equities, you're not at peak Ukraine war stress, but you are on your way to real stress levels. And oh, by the way, when you cross 200 on the NYSE new 52-week lows, the probability of going to 300 is very, very, very high. So these are new lows on the New York Stock Exchange. This is credit risk leaking over to equities. This is interest rate risk leaking over to equities. And, I think that's really the story of the week. Do we have anything else on the slides? I'd like to wrap it up.
What about the dollar?
Yeah, I think there's a dollar slide in there. Yeah, so this is, the dollar breaking point. To Rob's point, the strong dollar makes U.S. exports more expensive. It makes U.S. companies less competitive to sell products globally. And as you know, as most people know, I think 55-60% of sales inside of S&P 500 companies are international. So the strong dollar is literally going to hammer corporate profits. That won't be right away, but over the next 2 quarters. And oh, by the way, the street thinks that we're going to have 10% earnings growth, next year. So we're at like 225. We're supposed to go to 245. I think maybe 230. We're supposed to go to 240, 245 in terms of the S&P 500 earnings expectation. So the front end of the yield curve, treasuries, for example, corporate bonds, the real earnings yield inside the S&P is extremely the differential between bonds. It's rich. Equities are trading really rich to bond yields, especially on the front end. And so the dollar here is pointing toward a breaking point. Historically, 3 out of 4 times when the dollar was here, the Fed capitulated. And that didn't happen last fall, but it didn't really last that long up there. Okay, it was a very, maybe 2-3 month period. So the probability that the Fed is breaking something with the dollar, the global wrecking ball, as we call it, is pretty high. But that's a good recap on the morning from the chats. We run, like I said, the bear trap support. Most of our clients are on the institutional level on the Bloomberg terminal. We work with clients around the world. We're giving you kind of color from the morning, so that lens on that buy side conversation. These are points that we're pulling out of the chat, the conversation with the institutions around the world, and we're kind of giving you kind of that lens because there's a lot of volatility in the market. There's a lot going on. Wanted to bring it to you today. In closing, anything, Rob?
Um,
Really concise.
I think there's an interesting, should we talk about the oil at all? Right?
Well,
It's
you know,
down 3%
I think
here.
that may be another call. Maybe oil, clearly is rolled over. The oil equities were leading the market for the last couple of months, and now you've seen, I think there were 90% of the stocks were above the 50-day moving average, and now that's coming way down,
Well, I'm talking about like general oil, right? I mean, it's down 3% here.
down 3%.
Yeah.
So so the Russians, we've been in this period where the Saudis and the Russians have unusual control over oil. What's happening? Are they losing control over the market, or is the market starting to price in recession?
Well, that's the thing, right? So, the market, I think oil has been running hot. I think part of the oil rally in September was pull forward demand from China. They're in their golden week right now. It's a big holiday week in China. It's a lot of traveling going on, so they may have basically pulled oil demand forward to prepare for a big surge in travel. Of course, we've seen that in the past, right? When China has these big events going on, sometimes that just leads to a temporary surge in oil demand. Now the Golden Week is this week, so next week things normalize again. And then there was also a rather surprising decision by the Russian authorities to basically ban refined product export. And people thought, okay, this is another way for Russia to get back at the West for their support in Ukraine, and that may very well be it. But there's another reason why they did that was because they needed the diesel for the harvest season. So
Okay.
now, this morning, Russia signaled that part of that ban may actually be lifted pretty soon. And then of course, we had an OPEC Plus meeting this morning. People weren't expecting anything out of that. There wasn't any expectations out of that. So I think perhaps any momentum going into that OPEC Plus meeting, maybe it's a sell the news type of event. But I think thirdly, okay, if we look at all the data, we look at week ADP report, we look at a week Citibank credit card data. Those are high frequency data, right, for the month of September. And then people are starting to worry, hey, wait a minute, maybe the US consumer is starting to slow down, right?
Yeah.
But this is something that we've been waiting for a very long time, right? We've
Yeah.
been calling the debt of the US consumer for a very long time. I'm not sure if it's dead yet, but I'm sure that, this pressure from higher interest rates, excess saving is gone now. There is the disposable income has been eroded a lot through inflation.
Yeah.
Now you're going to have
We got to keep this under, very short.
so that's I think the market may smell a weakening U.S. consumer, and it's starting to hit oil now.
Okay. Well, once again, Larry McDonald with the Bear Traps report. Nice recap of the morning from the institutional chat. Clients in 23 countries, hedge funds, mutual funds, pension funds. This is kind of a concise recap of what we're seeing. There's a lot of intensity going on, a lot of volatility in the market, interest rate volatility, equity volatility. We want to give you kind of a really important lens on that conversation that we had this morning with the institutional investors. Thanks for joining us. Our new book is coming out in the first quarter, When Markets Speak, and we'll be talking about the book and previews. It's going to be, I think, a big blockbuster. Our first book is a New York Times bestseller about the failure of Lehman Brothers, and this kind of picks up where that left off. Thanks so much, Larry McDonald here. Thanks to Valentina Sanchez, Robert Van Battenberg. As always, fantastic job.